Imagine a world where US debt is out of control and the government carries on spending, despite their debt being massively expensive to service. Well, this is what's happening in the US right now, and instead of stepping back from it, they actually seem to be ignoring the problem. So in this video, I'll explain just how big this problem is, what's likely to happen, and the consequences of this ballooning debt. Today's video is sponsored by Trading212, a UK commission-free investment platform. Let's begin with the US debt situation right now. Now, there are two ways of looking at debt. You can either look at the amount of outstanding debt, that's a total amount of bonds which have been issued which haven't yet matured, and that would be measured in dollars, but more frequently you will measure it relative to gross domestic product. Think of that like comparing your credit card debt with your total income. So here I've compared US debt to GDP with other countries, and you can see it's currently at just over 120% of GDP. Only two other developed countries have a higher debt to GDP ratio. That's Japan, which has had a very high amount of debt relative to its GDP for a long time, and Italy. France, Canada, the UK are just behind the US right now. So that's the level of debt, or you could call it the stock of debt for the United States. Another way to look at it is in terms of flow. In other words, how much new debt is being piled on to the existing debt. And here we'd look at something called the fiscal deficit. Now, if the government is running a fiscal deficit, it means it's spending more than it earns, and it has to plug the difference by issuing debt. So a big fiscal deficit means a greater debt to GDP in the future. Now, if we look back at the fiscal deficit for the United States, you can see that during wartime, it gets really large. And that's because the government has to borrow to fund massive spending. The pandemic in 2020 also made debt balloon, understandably. But now we don't have a war and we don't have a pandemic, and yet you can see that the US deficit is still continuing to increase. Now, you can probably guess that if we've got a large fiscal deficit, then we're increasing the amount of debt over time, and if we project that into the future, we'd expect the debt to GDP to steadily increase. And that's exactly what we see if we look at a forecast from the CBO. That's a non-partisan organization in the United States, the Congressional Budget Office, which has models which allow it to project the debt dynamics into the future. Here you can see that debt to GDP ratio historically going back to just before the Second World War, and you can see the projection beyond 2025. And sure enough, it's steadily increasing. Now, in their report, the CBO says that debt increases in relation to GDP, exceeding any previously recorded level in 2029, and it continues to soar through 2055. Now, based on what the CBO knows about future spending, it can also project out the fiscal deficit. And they split it into two things. One is the primary deficit, which excludes interest payments on debt, and the other component is those interest payments. And of course, those have increased recently because the yield on US Treasuries have increased. So the overall debt servicing cost has also ballooned. So the primary deficit is the shaded region at the bottom. That excludes net interest. Then the lighter pinkish region are those net interest costs. Notice how those are quite large and getting larger. And the total deficit adds those two. So not only is the debt to GDP projected to increase over time, that deficit is also expected to increase. And according to the CBO, one of the primary drivers of that deficit is greater net outlays for interest. They expect those to increase as a percentage of GDP more than 1.5 times by 2055, by which time they expect the total deficit would be 7.3% of GDP. Now, notice this isn't a recent phenomenon. It's not about Republican or Democrat. Both political parties have been spending more than they earn in taxes because it's politically very difficult to step back and say, look, we're going to have a primary surplus, because it means either charging more in taxes or cutting back on spending, neither of which is popular. And rating agencies have responded to this fiscal irresponsibility. In 2011, S&P first downgraded the US from AAA, which is the highest credit rating, to AA. Then in 2023, Fitch followed suit. Notice that was when Biden was president. And then in May of 2025, Moody's followed suit and downgraded the US from AAA to AA1. And if we look at the reasons that they cite in their reports when they talk about the downgrade, there's a very strong similarity between what Fitch said in 2023 and what Moody's said recently. In 2023, the talk was of expected fiscal deterioration over the next 3 years, a high and growing general debt burden, and more worryingly, they said that there's erosion of governance relative to AA and AAA rated peers, those are countries which do care about their debt to GDP ratio, over the last 2 decades. And they talk about a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters. And Moody's also stresses that this is not just a Republican or a Democrat issue. They say successive US administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. And the consequence, of course, is that persistent large fiscal deficits will drive the government's debt and interest burden higher, and US fiscal performance is likely to deteriorate relative to its own past and compared to other highly rated sovereigns. So a very consistent story between the different rating agencies, but a story which the US government has decided to ignore. Now recently, House Republicans have passed a bill called the Big Beautiful Bill. It's a big tax and spending bill. They have made lots of cuts to spending while at the same time cutting taxes. Now, if they reduce taxes, of course, that reduces government income. So that means you have to cut spending by more than that in order to reduce the fiscal deficit. There are many concerns, however, that the bill doesn't do that. It doesn't cut spending enough in order to pay for the tax cuts. Here's what the spokeswoman for the White House said about that.
Is the president okay with this bill adding to the deficit?
This bill does not add to the deficit. In fact, according to the Council of Economic Advisors, this bill will save $1.6 trillion. And the president absolutely understands and hears the concerns of fiscal conservatives and of Americans who want to get our fiscal house in order. That's what the intention of this bill is.
So the argument is that by stimulating growth, GDP will increase in future, and that'll more than pay for the tax cuts because there'll be a greater amount of GDP which is then taxed, and that increases government revenue. However, the CBO doesn't agree with that assessment. Here's its projection of what's going to happen to the US fiscal deficit. And what you can see is that this bill will add to the deficit. That in turn will add to US outstanding debt. Now, before we dig into why the deficit's a problem, I'd like to talk about Trading 212's ISA, and today's video is sponsored by Trading 212. I've been using Trading 212 stocks and shares ISA for a few years now, and I love the platform, and here's why. Firstly, it charges no account fees, or any monthly or annual subscription fees. Secondly, it offers lots of choice for my fund portfolio, which is what I have on Trading 212. Trading 212 offers over 13,000 ETFs and stocks, and these are from the UK, US and Canada and Europe. And finally, it offers new functionality all the time. The product managers and software engineers at Trading 212 are always busy on our behalf. For example, it offers fractional shares, pies and auto investment features bundled into its ISA. And if I had to choose my favorite single feature, it would probably be pies, where you can create portfolios within your ISA. I've got lots of ideas for my fund portfolio, which I talk about on this channel, and pies let me track those ideas and monitor them separately. If I want to rebalance one of my pies, I can do it with a single click. You can also fund your pie using regular investing via direct debit, and that encourages regular saving, which is a great habit. You can also reinvest any dividends back into the pie automatically. If you are scratching your head trying to decide what to put into your pie, there are lots of popular portfolios which are created by professional fund managers which you can copy or just use for inspiration. Trading 212's ISAs are flexible, which means that within a tax year you can withdraw cash and put it back into the account without affecting your ISA allowance. Now, as a viewer of Pensioncraft, you get a special offer from Trading 212. You can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is RAMIN, RAMIN, and you'll find a link to that offer in the description below. So why is US debt a problem? For a country and an economy which is as large as the US, then I think they do have a lot of leeway and a certain privilege when it comes to issuing debt. There was a nice report from Vanguard in 2023 where they looked at the concept of fiscal space. The idea behind this graph is that you've got debt to GDP ratio on the bottom, and the distance between the current debt to GDP and the maximum sustainable debt burden is your fiscal space. So the US is currently at 120% of GDP. How high could it go before the debt dynamics become unsustainable? Well, that in turn depends on how much primary surplus the government is willing to have. Remember, primary surpluses are very unpopular. The way you get them is to tax more or spend less. And historically, the US has been very loath to have one of these primary surpluses. Now, Vanguard thinks that the US could maybe go to a primary surplus of 2%, and that gives it a huge amount of fiscal space. It could probably increase the debt to GDP ratio by 100 percentage points from where we are today. So if this analysis is true, it means that the US still has a lot of leeway when it comes to issuing new debt, and there's not an immediate problem which will lead to unsustainable debt dynamics. That's assuming that we don't have another crisis, of course, which would make the debt balloon very rapidly. But we saw earlier that the US is spending a lot on servicing its debt. And in fact, if we look at the 2024 fiscal year, you can see the breakdown here from the CBO. The cost of servicing US debt was $881 billion. And to put that in perspective, that's more than the US spent on defense. That was only $850 billion. And there's a great quote from the historian Niall Ferguson, who said, "Any great power that's spending more on debt service than on defence is probably not going to be great for much longer." But it's not just about spending on defence. The government also has less money to spend on other things, which could be stimulative for growth. It could be infrastructure, it could be education, or it could just be looking after the sick. The spending on net interest is also greater than the US spends on Medicare. So what are the consequences of ballooning debt? The most obvious one is that investors are demanding a higher rate of interest to lend to the US government. If we look at 10-year US debt and 30-year US debt, notice how the yields are currently very high. Now that sometimes can be because of good reasons. It could be because of higher growth expectations. And yet what we've seen recently is a downgrading of growth expectations. So this is not a yield increase for good reasons. It's because many investors are shunning US debt, particularly long-dated US debt. You've probably heard about bond vigilantes. Well, these are investors who will not buy debt if they think the government is fiscally irresponsible. We saw the pushback you can get from bond vigilantes quite recently here in the UK, and that was with the Truss Kwarteng budget. So the yields we're seeing right now in the US were comparable to those which we had about 10 years ago. Now normally when we see US yields going higher, you'd expect the dollar to strengthen, but in fact we're seeing the opposite, which is more evidence that international investors are shunning US assets, partly I think because of worries about debt sustainability. So what other problems do you get from ballooning debt? Well, we've already seen that you've got less money to spend on things which could stimulate growth, things like infrastructure and education spending. Now, if the yield on US government debt increases, that increases borrowing costs for everyone. And that's because government debt sets the risk-free rate. Everyone else borrows at that rate plus a credit spread. So when the government's cost of borrowing increases, it does so for everyone, companies and households. Now, if you get a higher cost of borrowing, well, that means that companies borrow less. And that means they've got less capital to expand, and that can slow down growth. Particularly for growth companies, this could be an issue. And of course, it affects households. If borrowing costs are higher, perhaps there's less consumer confidence, and that means less demand for the services and goods provided by US companies. So these are the pathways by which we can actually see US growth start to falter because of unsustainable debt dynamics. And of course, if we get another crisis, whether it's financial, geopolitical, or health related like the pandemic, there's going to be less room for the government to spend, to stimulate the economy, and to soften the blow. So this fiscal capacity idea is also very important. So what's the solution to this problem? Unfortunately, I think it requires a plan. And I think it requires a plan that the government has to stick to, and it's a plan which the US public is not going to like. Nobody likes more taxes, nobody likes austerity. And yet that's what's required to reduce the fiscal deficit and to get debt to GDP to fall. To the UK's credit, it has been very strict, perhaps too strict, about keeping debt to GDP under control. So I don't think there's an immediate problem here for the United States government. They've still got a lot of fiscal space, if you believe Vanguard's analysis, such that they could still increase their debt to GDP. But we're already seeing quite worrying signs in the US currency, which is selling off as yields increase. That's very unusual. And we're seeing people across the world invest less in US assets. Now, if there were some kind of accident in the US Treasury market, perhaps it would make them change policy. And I think that would be a healthy thing. That was certainly the effect it had on the UK government. But if we don't see such a crisis, I think it's likely that we'll just carry on as we are. Government after government in the US runs a fiscal deficit, and the debt to GDP carries on growing. Now, maybe you're worried about what's going on with the US debt situation. If you are, please tell me in the comments. I'd love to hear what you think. And don't forget our offer from Trading 212. As a viewer of PensionCraft, you get a special offer where you can claim free fractional shares worth up to £100. Open an account, verify it, fund it, and use my name as the promo code, which is Ramin, R-A-M-I-N, and there'll be a link to that in the description below. And, as always, thank you for listening.